Welcome to episode 3 of Kontrarian Korner. My name is Ben Kelleran. Today we have the pleasure of talking with Matt Warder, who is an expert on all things coal, and he recently took over the Coal Trader. So if you guys are interested in the sector, you should definitely check that out. Matt, thanks for coming on.
Ben, happy to be here and happy to chat with everyone. It's been a really pretty incredible few years for coal investors. So it's been great to get to know everybody in the generalist and kind of retail space and get to talk about this industry, which few people understand, and even fewer people know how great the people are within it. So and just happy to be out here talking about an industry that doesn't get much love in mainstream media.
Yeah, it's not a AI play, at least not yet, but a lot of people chasing the video and whatnot.
Hey, you got to power AI somehow. Just saying.
Yeah. I was thinking we could start with talking about the long-term future for coal. One of the themes that I've been watching is basically underinvestment across the commodity sector, whether it's oil or copper or different projects. And so I think coal has definitely been a victim of that for 15 years. But I'd be curious to hear your thoughts on what the picture looks like for 5 years, 10 years out, and how long of a runway the coal sector has for investors. So,
yeah, well, it's your mileage may vary depending on what region of the world you're talking about or what industry that coal services that we're talking about. But in general, on the industrial side, coal isn't going much anywhere for a good long while, probably the vast majority of our lives. And on the power generation side, it's less about whether or not it's going away, but whether or not Western economies can, wean themselves off of, coal-driven power generation. Opinions vary as to how successful ultimately they'll be. Now, obviously, 2021 was a bit of a, come to Jesus moment, I think, for Europe in terms of their reliance on coal, which they thought they could phase out like that. But the truth is, whether we're talking about the energy transition or the greening of the steel industry, those are processes that take decades to resolve, not necessarily a decade or years. The success is measured in the long term, not necessarily in the short term.
Yeah, I think one of the things that I've been kind of seeing is like signs of basically a longer commodities bull market. And I think it's probably something that is at least 5 to 10 years, but it'll be interesting to see how kind of coal participates. Be curious to go ahead.
I think the higher quality materials have at least a 20-year runway, which for most of the mines that are in existence, that's about how many years of reserves they have, kind of on average, somewhere between 12 to 20 in that range. So I think if you're in that ballpark, provided that you're not in an area where domestic consumption is in decline, you're probably settled pretty well for the near term.
Yeah. One of the things that I've been looking at is some of the past sectors that have been way out of favor, like the tobacco sector, where you saw very cheap valuations, lots of buybacks, huge capital return programs. I think that's something that we have started to see over the last couple of years, depending on the stock. But I'd be curious to hear your thoughts on like a company like AMR or some of the other companies that maybe have significant capital return programs in their future.
Yeah, I mean, I've used that analogy myself. They're kind of like the new tobacco stocks. So I think that comparison is pretty valid to some degree. The companies that have fared the best have chosen the buyback route, though. And I was always kind of on the fence historically about, shareholder returns are shareholder returns. Do you do dividends or do you do buybacks? What's your flavor? It doesn't really matter. And I've come out of the last couple of years relatively convinced that buybacks are the way to go, especially for an industry that, there's not a lot of, you could consolidate the industry. You could do mergers and M&A. You could try to build scale through merger of equals. But in the meantime, there aren't really many new projects to bring on, period. The world, from a political standpoint, has told you they don't want them anyway. So there's not much else to do with capital, the free cash flow that you make in the year in the interim, other than boost your share price. That's about all you can do with it. So AMR and CEIX have the two strongest buyback programs on at the moment. I mean, thermal coal prices are really not great at the moment, and CEIX stock has held up very well. And I think we've kind of hit an inflection point in natural gas markets, so they could they could do relatively well going forward, at least through summer, or at least seasonally. And as long as they're making enough free cash flow, which they can, because they're lowest cost provider on the cost curve into Europe, then and one of the lowest, if not the lowest, into India, that they'll be able to kind of continue. Maybe not at as frantic a pace as they did at $30 or $40. Can't do as much at 80, but I think they're relatively committed to it. They'll stay the course, and we know AMR is. That's part of their selling point.
Mm-hmm.
And they've retired 30% of the float, I think, so far, 35% of the float.
Yeah, not bad for a couple of years.
Yeah, exactly. I mean, they've gone from 3 to 450, and now we're kind of correcting along at at 300, which I still think is a bargain for them, just given what the long-term trajectory of met coal prices is. I don't think we're going to see much below 200 in terms of PLV for maybe forever, but I'd say at least unless there's synchronized global recession or something like that.
Yeah, I guess on console, I'd be curious to hear an update on what's going on with the terminal there. I know they're a big the Baltimore bridge has been an issue for them over the last couple months. I'd be curious to hear an update on that.
Well, I live in Annapolis here, and ships are moving, so I'm pretty sure the channel is completely operational at this point. The Army Corps of Engineers had said kind of all along it'll be good to go by the end of May, and then they issued a statement, I think it was last week, that they've resumed shipping for the most part. So they removed the dolly and got that back to port. Most of the debris has been removed from the middle of the channel. And the Chesapeake in general is not a very deep waterway. The average depth over the whole of the Chesapeake is like 6 feet. So there's the one center channel that they drag to 39 feet that allows Panamax vessels to get all the way up to Baltimore and then out. And I think, as far as I know, that's fully operational as of today.
Okay. That's good to hear. It sounds like it'll be baked into their second quarter, but not an issue moving forward. So
yeah, I think so. And if given that the outage has only been a month and a half, they'll be able to make up tonnage shipments. They were able to ship a little bit in alternate ways, and they'll talk about that on Q2 earnings. But yeah, I think that's all in the rearview mirror at this point in time. So it's all full steam ahead, quite literally going forward.
Yeah. One of the things you mentioned, you don't see coal prices going below $200 moving forward
on the met coal side.
On the met side. Mm-hmm. And I'd be curious to hear your thoughts on like where you think we might be headed 5-10 years out longer term. Because I think like even at current prices, like all these companies look pretty cheap to me. But if we get another kind of bumper crop type year or a couple of years or basically a commodity super cycle, I'd be curious to hear your thoughts on where we kind of could be going over the next 5 years, say.
Yeah, well, the coal industry sort of moves in 5-year cycles anyway. And in that period, you have one really good year, one really bad year, and 3 kind of pretty good years. And if we think about the last 2, we've had one amazing year. We had one bad year, the COVID. And, now we are kind of here in this, range, which has been, it's fine. Everything's fine. Like this is probably what a bear market looks like for coal going forward. So, $225 PLV or something like that. The premium low volatile coal index that Australia uses, probably, $95 API2, which is a thermal coal price into Europe, probably $120, $115 Newcastle, which is the Australian thermal coal benchmark. I think those are kind of the levels that we'll see mark bottoms, plus or minus 10, 15, 20%, something like that, going forward, because the cost structures have just elevated so much at this point. And, given that most everyone is debt free to some extent, if you don't have to service your debt, you don't have to produce as much. So you can take more flexibility with your production. You can reduce weekends and overtime and kind of manage your operations like that. You can't shut down unless you really intend to do something, at least in the United States. But there are things you can do to kind of right-size production during quiet periods of the market like we're having now.
Yeah. So we talked a little bit about AMR. I'd be curious to hear your thoughts on that, because I feel like I've kind of missed the boat a little bit on that one. But if it does kind of continue to correct over the next month, I might be looking to fix that mistake moving forward.
I mean, yeah, the bulk of the move is in the rearview mirror. The move from $3 to 300 to 450, that part's behind us. But going forward, you mentioned tobacco stocks, like, BTI has a 10% dividend or something like that. AMR is going to do buybacks, but that capital return is going to look really similar over time. And if the market gods are going to give us these 30-40% corrections during periods where spot prices come down 30 or 40%, with regard to what the average is going to be for the year, which is really what they should be based on, right? Mm-hmm. Instead of if we're going to follow the moving monkey, as Hedgeye says, all over the place, in terms of price, then these shoulder season corrections are gifts to us. So there's upside relative to where I think AMR's valuation is of 30% for 300. I think it's a $450 stock. That's I want to say 7 or 8 times earnings. Like they'll have captured the positive re-rate at that level that I think the industry should get. And of course, my opinion, what's that worth? But that's where a lot of cyclicals tend to wind up, right? Mm-hmm. A 7 to 8x vein. Over time, as they reduce that float, that top number is going to go up. So it's moving into more a period that's going to look like a BTI or a Philip Morris or something like that, and less like the crazy run that we've had here over the last couple of years. But again, like, these stocks are volatile in a way that tobacco is not really. It's cyclical, it's predictable, and as long as the upside remains for any production outage where 2 million, 3 million tons are pulled out of the market for a long period of time for high quality material, we're going to have another spike up to $350, $400. So that's what you're in the market for, to capture the beta of, if that's what you're after. For me as a holder, I just need to see that 10%, 7% a year with my zero cost positions, and I'm good.
You're looking for the dynamic where everyone's fighting over the last share sometime down the road.
Yeah, exactly. I mean, I hope to be that person, but it probably won't be. It's probably going to be somebody who has a lot more shares than me, because I dabble around too much. Yeah.
I guess we also touched a little bit on console. I'd be curious to hear your thoughts on natural gas, how that ties into some of the thermal stuff. And because one of the things I've started to get a little bit more bullish on natural gas kind of over into the back half of this year into 2025. But I'd be curious to hear your thoughts on how much thermal will kind of follow that move. If you think natural gas kind of has a ceiling at $4, which I've heard some people talk about, but be curious to hear your thoughts on kind of the interrelationship there.
If there's one thing I've learned about natural gas over the past 4 or 5 years, is that I'm not a good natural gas analyst, to say the least. I mean, it's one thing when the market situation is incredibly obvious, as it was back in 2021. I had started a contract consulting with one of the major research houses, and I looked at their coal-fired generation and noted that it was impossible to meet. It was like 1,200, 1,300 terawatts of generation. And when I talked to the analysts who had put that number down, they'd actually used it to balance their forecast. So they were moving coal numbers up and down instead of recognizing that the lack of coal-fired generation was a problem that would impact natural gas and power demand. So in that instance, coal was sort of the weakest link. in that supply chain, and I just happen to see it. But as for natural gas, now we have all these LNG terminals that are going to come on at some point in time, which is supposed to tighten up the natural gas market. We're probably overpiped, but we're not necessarily piped in a way that is very efficient at bringing product to market. So there's just too many factors in there for me. Productivity's really increased. We had so many drilled and uncompleted wells, heading out of the pandemic. We've moved through those, and the Haynesville has come on. I'm a price taker on the natural gas side and an information taker on there as opposed to a generator of it. My suspicion is that between $2 and $4 is probably the normal range in which nat gas can function. But that said, there haven't been many upside surprises in terms of delivery to market. So always kind of hold my breath there. The issue now that I see in the thermal coal market domestically is coal stockpiles are high. So from a domestic perspective, even if natural gas does catch a bid and allow coal prices to move up, which would make mines more economic, there's a lot of coal on the ground at utilities. And so we're going to have a hot summer, and we're going to have to burn through those inventories. I haven't looked at nat gas inventories domestically in a long time. But those are the conditions that have to be met first before we have a material appreciation. Anything that looks even remotely like we saw in 21, 22.
Yeah.
So, I think $4 is a pretty good proxy for a ceiling, but again, that would $4 means 60, call it $75 central app coal, and maybe $80 northern app coal, probably less than that. So that's like traditional price levels that a lot of central Appalachian mines in particular can't support. The Illinois Basin's okay. They have costs in 35 range. Northern App's okay. They have those big long walls with costs in 35 range, so they can exist and sell into the domestic market and be fine. It's just what does demand and what does stockpiles look like? Personally, I think we got to build out a lot more of these AI data centers so we can draw down those stockpiles and produce some more. But that's just me. Yeah,
no, I've been seeing some interesting charts on what data center demand is going to do to the electric grid, and I'm pretty confident it's not going to be met by solar panels and turbines. So
no, I mean, to the extent that they can build out data centers and co-locate, like small modular nuclear facilities with them. I know Oklo is really working closely with some of the data center build out companies on that note in particular. I think that technology has promise, using spent nuclear fuel, to do kind of small scale power generation for industrial use. I like that model. I think that's, if you're going to use small generation capabilities, if you're going to use solar, co-locate an industrial facility with it so that it doesn't draw as hard on the grid. Like, those are the sorts of things that we can actually do to kind of prevent things. But as to power demand, I mean, if we built them at the pace we want to build them without making those concessions, it's going to be massive draw on the grid.
Yeah, I think it'll be interesting to watch. I know that our energy policy has been a little bit shoddy in recent years, but
I don't think we've ever really had one in my lifetime. So that encompasses yours.
Yeah. So I'd be curious to hear your thoughts on Peabody. From some of the stuff that I've seen, it's looking pretty interesting, and it's one of the ones that I own. I think I'll say that I've been looking again at some of the 2026 leaps and getting tempted as well, say. So I'd be curious to hear your thoughts on Peabody.
Yeah, I mean, it's in my book, it's one of the 5 or 6 that you have to look at. And the reason is because they're going to grow. And that's really it, Centurion is going to be a mine in Australia that will capture the premium low volatile benchmark, which I think is going to be very well priced over the next few years. It's probably going to add about, I don't know, call it $200 to $300 million in free cash flow, like not just profit, but full on free cash flow to the bottom line. And And management has come around to buybacks to some degree. Elliott's not out, but they're almost out. Like most of the issues that are creating the hair on it in the near term are in some way, shape, or form being resolved. But my concern over the longer term for both them and Arch is what are they going to do with the Powder River Basin? I do think the Powder River Basin could have a use if you wanted to build additional facilities to again to supply data center build out. But I don't think we're going to have the political environment to do that as a country. And that bonding out there in Wyoming, is a concern and a drag on the stock because they have to hold all this cash, on their balance sheet that's restricted. They can't do anything with. They can deploy that, billion. I don't forget how much it is, that billion plus into the market to buy back shares. Holy moly! I mean, they'd be $40 tomorrow. But instead, we kind of have to sit and wait for Centurion to come on and for the market to realize that, they need to crank up the multiple. I think it's at $22 or wherever it was a couple of weeks ago. That's too low, a price for them. And again, I don't get caught up in the quarterly fluctuations of market spot prices. So, I'd rather buy when the market's going to give me a discount. And then, if it's going to trade in a range until Centurion comes on, you can always, sell some at, 20. Buy some at 22 and sell some at 25 and rinse and repeat that for a long time until the market comes to its senses. I mean, this is one that's liquid enough for you to be able to trade, for you to be able to own. You can take multiple approaches to it, but Centurion is too important to ignore is probably how I'd phrase it.
Yeah. I think I was looking at some. I think Elliott's down to, was it 3.7 million shares as of their most recent update, but I think they'll probably be out by the end of this quarter, and I think that's.
I would assume so, yeah. And for me, it really hasn't been that relevant. Like the price levels have been for the equity have been very well telegraphed. Pretty much every actor has been kind of taking the same action. So I bought some down below 22, and I split, above 23. But I have this core position. I'm just not going to sell because I'm waiting on it to appreciate. And it's zero cost at this point. So there's not much point in me adjusting it. Just we're going to sit and be patient and let them do their thing. I know everybody loves to complain about management, but from an operational perspective, they've been doing okay.
Yeah, I think it'll be interesting to watch. I think next couple of years when people realize that Centurion's like right around the corner, I think it's going to be. We get one of those like face ripping rallies where it's like 1 to 3 month period where it just kind of goes and goes. So seen that in some of the other stocks. I think we'll see Peabody. So
that's been the gift that this kind of stupid seasonality has given to us for years in a row now. And I'm still not overly confident that that'll continue. For a number of factors, but as long as we kind of understand what the outcome is going to be, it's hard to ignore.
Yeah. One of the other stocks I own that I think is still undervalued, not buying anymore here, is Warrior Met Coal. So I think that's basically got one of the best setups for people that are investing with a 3 to 5 year time frame. I've talked a little bit about Blue Creek, but I'd be curious to hear some of your thoughts on Warrior and if it's basically a slam dunk if it goes below 60 again, or kind of what your thoughts are on Warrior.
I think so. That's kind of my view on it. I mean, anything in the 50s at this point, you have to pay very close attention to. And I think you have to, accumulate, maybe even back up the truck. That's dependent upon, of course, what is there something from a macroeconomic perspective or something external to Warrior's activities themselves that is pushing down prices or pushing down global economic activity. Like those are the things you have to worry about with with a company like this. Like I think they'll be able to execute reasonably well. CapEx inflation is probably a risk, but it's a risk for everyone. And we wouldn't be talking about 20, 30, 40% of CapEx inflation. We're talking about like 10 at this point. Because it's already gone from, I remember when I originally built the model for Wood Mackenzie back in 2013, 2012, something like that. We assumed that the CapEx cost of construction was going to be around 600, 700 million at the time, but that's 13 years ago. So that was always the number that they threw out there, even as late as like 2017, 2018, when there's pretty material inflation during that period.
Yeah.
So now, like, I remember the market got sort of upset when they said it was going to cost $1 billion, and I remember buying a whole lot, and I'm pretty happy about that right now, because you should expect that. I mean, these are things that you should incorporate into your forward models, because they're real and they're happening sort of as we speak. But I think what are they at 1.1, 1.2 billion now for the estimate?
Somewhere in there.
Yeah, like that's what it's going to be. We're far enough along in the process now that they've already spent 500, 600 million on it. So you're only going to get inflation on the back half of that. So the cost creep is not going to be as big an issue as even some really think it is.
Yeah, that inflation dynamic is something that I think will be interesting to watch in another sector I follow, which is some of the offshore oil services stuff. But on Warrior specifically, do you think there's going to be any issues between now and 2026 with them bringing Blue Creek online?
I mean, geology always can work against you. So there could be geological difficulty. I mean, these are the mines in Alabama. I've got my Alabama hat on today because I knew we were going to talk about Warrior. The mines in Alabama are really deep. I think number 7 is like 2,000 feet deep or something like that. That's part of the reason why, even though they're long walls, their costs are at the mine level almost pretty close to like the Central Appalachian continuous miner operations, stuff like that. Smaller, less productive mines, right? So it's deep, so geology could sneak up on you, I suppose. But I mean, most of the maps that I've seen on the area, I think we kind of know where everything is. So really, it's just keeping labor happy probably is a bigger risk than anything else. They had they had a union strike there during I think I can't remember if it started in 2020 or led into 2020. But they they basically won. They broke the union at the mine there. People had to go back to work. So I would guess that labor might be a bigger issue than cost overruns and stuff like that. If you have trouble finding people, that affects productivity.
Yeah.
But I honestly, it's kind of an existential risk for everybody. So even that isn't even unique to Warrior. Yeah. So
and when Blue Creek does come online, what does that do to kind of their average cost? Is that a significant change or pretty similar to their current operations as far as what it looks like for cost to pull the coal out of the ground?
I mean, I think this one's going to be lower cost, pretty significantly lower cost than the other two. First of all, it's newer, so it's going to be more productive at the outset. Mm-hmm. Number 7 and number 4 have been around a long time, and the further you move away from the portal, the more cost it is to bring all the coal and all the people and everybody out. And that's that can be a drag on productivity too. Cost wise, I think this was going to be probably $70 to $75 a short ton at the mine, which is screaming low cost for down there at this stage. Number 7 is pretty similar to that, maybe a little bit higher. Number 4, I think, is probably more like 100 and something. But that's it's a good number. I mean, it's going to be pretty badass mine, and the high vol A quality that they produce is not the same sort of high vol. Like it's almost a tweener mid vol high vol A coal, and the coking properties are going to be more similar to number 4 than to like a typical Central Appalachian low vol or that AMR would produce. Or so I think it'll fetch a really excellent price relative to the high vol A index. I think it might even be priced off of PLV if they play their cards right. So I think my model right now has them at around 800 million in free cash flow per year at 225 PLV met coal by the time we get to 2027, 28. And that's a lot of money that you could buy back shares with, that you could go out and acquire something. There's a lot that can be done with that level of profit.
Yeah, I think if that's what the model looks like at that price level too, it'll be interesting to see what it looks like if we do get one of those good years in kind of every 5 years that you mentioned. So,
yeah.
Do you think it's do you think management kind of goes down the buybacks route, or you think they basically dividend out and do some of the stuff that we've seen with some of the special dividends over the last year or two?
Yeah, they've been doing the special dividend route in the interim. I think because I'm speculating. They haven't told me. I'm just guessing. They don't want to commit to exactly like, we're going to buy X amount of shares a quarter. We're going to spend this much money on it, because they know that the value add to shareholders is going to be completing the mine.
Mm-hmm.
So I sort of wish they would say, well, if we had to do it right now, we'd prefer buybacks. I'd like to hear them say that. I really would. But even just communicating, look, on one of their calls, they said recently that they're not focused quarter to quarter. They're focused on the year. They want to hit their annual target, and they'll do whatever they have to do to meet that goal. Right. In the same way, I think they should probably say, look, we're focused on one thing and one thing only, and that's developing this operation, which is going to be transformative for the company. We need to focus on that. And that's why we're issuing special dividends, because we don't know exactly how our budget is going to finish up at the end of the year, and we don't want to get out over our skis with regard to financial commitments.
Mm-hmm.
If they said that in that sort of straightforward manner on an earnings call, I think people would stop talking about it, because they'd be, okay, well, that's what they're going to do.
Yeah. I think it's interesting because everyone wants to see the AMR type path, but I think it's kind of basically a 2-year countdown is the way I would kind of look at something like Warrior. So, I think the last.
I think that's right. You phrased it as, this is the one to own for 3 to 5 years. That's the time horizon for this. First you have to bring on the mine. That, I think, alone in and of itself can probably double the stock from here. But then you get into, what are you going to do with the cash flow? If they can buy back their shares at, $100, well, that's, I don't know what their float is right now. But
I think it was right around 50 million shares, somewhere in there.
Okay, so 50 million shares, $800 million divided by $100.
Yeah, 52 million shares. So that's a lot of buybacks. So
yeah, I mean, 8 million shares a year. That's divided by, what was it, 50,000 shares or 50 million shares?
52. Yeah.
Yeah, so you can buy 15% of the company every year. Sign me up.
Yeah, I think just a matter of patience, but that's tough for a lot of people nowadays.
Yeah, exactly. So that, 2 years to bring on the mine, the market should reflect that by then. And then 3 years of some kind of shareholder return program that is incredibly aggressive. And this is a, giant winner over the next 5 years.
Yeah, I agree. One of the Australian miners that a couple of people have talked about that I don't own, but they made an acquisition last year that was pretty interesting, is Whitehaven. So that's one I think is getting closer to like that 50-50 split, which I think you've said a couple times. But I'd be curious to hear your thoughts on Whitehaven. I think it's still cheap like most of the rest of the sector. But I'd be curious to hear your thoughts on kind of what the timeline looks like for capital returns, what they might be doing with not those joint ventures I've been seeing some news on, but I'd be curious to hear an update on that.
Yeah, so they've talked about selling down 20% of Blackwater to help pay for the purchase. That's probably a reasonable thing to do, and having a strategic partner like that guarantees you offtake, at an agreed upon price. It guarantees that they're going to share in the upside of the company. But I mean, my mind with Whitehaven at the moment is they're kind of in a show me phase, right?
Mm-hmm.
The buyback is off. They were really buying back aggressively when thermal coal prices were insane. And they pause that as they digest this, which they should. Moving from being a 100% thermal coal company to a 50-50 met split is a really excellent investment for their future. The mines themselves don't fetch that, top tier PLV price. They receive a pretty significant discount on it, but the cost structures of the mines are really good. So what Whitehaven needs to do now is they need to prove that they can operate them. And if they go a year and they're able to operate them, and we get a sense of what free cash flow and cost structure and everything is going to look like under their regime, they'll be much more predictable in terms of share price performance going forward. Right now, it's still pretty fresh.
Mm-hmm.
So the equity has kind of been stuck in this recent range, but just the fact that we know it's connected more closely to the met market now means it's going to participate in met seasonality, at least more so than it did in the past. And so in turn, that means let's watch out and see how it behaves in July 1st when Indian and Chinese Q3 budgets open up and the spot market starts to react. Usually it takes about a month for that to get going. So, by August, September, you start to see things moving a little bit. So, I own it. I sold a little bit not too long ago, but still have a core position. I'm just kind of waiting and watching on it here at the moment. I think it's fine to purchase at the current level, but like all of the met and thermal coal stocks, if you're just starting a position, I think you have time to be patient. From here on into summer, I don't think you need to go all in at now or at any one level. Just buy some, track it, watch it over time. I do think Whitehaven's probably going to double over the period of the next 2 to 3 years. But again, they got to show the market that they can operate, and then I think they'll be rewarded with it.
Yeah, that's one I'm interested in, but I'm curious to see how it plays out with their acquisitions. The last one that I want to talk about is everyone's favorite coal microcap, which is Corsa.
Yeah.
But
Sure.
that one's been in the dumps for a while. I'd be curious to hear your thoughts on what's the stink bid price? What does it look like moving forward? If we do they really need one of those bumper crop years to make the stock work?
Yeah, they do. I mean, they've kept the windfall money they got in that legal settlement with the Pennsylvania Department of Highways or whatever. They kept that in the bank, which is probably wise. They have some debt that they need to retire, and they have a mine they need to bring on. All of that requires money, and they don't have much. I mean, they're not broke, but they're not. It's pretty close. And the domestic contracts that they signed last year are barely break even at maybe lose a little bit of money at the cost of the mining operations now. So, what we need to see this year is a successful domestic metallurgical coal settle. Last year usually settles between August and September sometime. Last year, if you remember, the auto strike was going on, so steel producers were a little bit nervous about how much they were going to be able to produce the next year. So they weren't necessarily willing to take what the market price was at the time for domestic met coal, which I argued was about 170, 175. Most everybody wound up settling for the equivalent of about 165, 170 met coal low vol, and more like 150, 145 in some instances for kind of B grade high volatile coals, but that range. And Corsa was on the lower end of it because I think they settled a little bit too soon. Literally, if you'd waited until September 1, I think it was, there was a truck accident at Caval Ridge where a truck slid and the price started just booming up right after that. So a couple of weeks difference in domestic settlement makes a huge deal. And Corsa has a little bit higher sulfur coal, so they get a discount anyway. So if you settle at a lower market price and you have a penalty to that market price that's leading you into territory and your high cost, that's leading you into territory you don't necessarily want to head in. That said, sulfur aside, the coal's pretty good quality. People know how to use it in blends, and if they can get a good settlement here this year, that bodes well for 2025.
Yeah. So I guess One of the questions I have, just kind of looking at their situation, why is this still a public company? Like, why has no one made a bid for it? If you kind of take that view of, okay, over the next 5 years, if I get the new mine online, get basically all these things working, like the valuation seems like it's way, way too cheap. But obviously you have the issues, like you said. Why is no one made a bid to take this private?
Well, I mean, mostly because they're not making any money. That's
fair enough.
That's a big thing. Yeah, they have. I mean, most of their market cap is in cash here at this point in time, I think. For a couple of reasons. Number one is it's kind of geographically isolated. The natural buyer for it is a private company called Rosebud that's in the area. But even then, like the mines in Pennsylvania are very spread out apart. Rosebud has mines in counties that are 50 miles away, 60 miles away. So blending it isn't really that great. And because they're small, they can't get preferential treatment from the railroads necessarily. And then export-wise, they had one of their salesmen or something was charged under the Foreign Corrupt Practices Act. So they have to export through traders now. So they're kind of handcuffed on what they can do domestically and what they can do from an export perspective. They have to give away, show a little bit of leg on price domestically, and they have to give away a little bit of money to traders on export. That's part of the reason why they're still where they're at. What I think needs to happen with them is that somebody's got to come in and recapitalize them. So whether that's doing a share offering or whether that's bringing in somebody to finance, the new Kaiser mine, which would double their production. I mean, you double their production, all of a sudden, like market cap's going to respond.
Mm-hmm.
But whether you need to get a loan to do that or whether somebody needs to come in and take a majority share of equity is another question. And some other folks are kind of circling the drain on that idea as well. Just the risk is, even if you do it, it's still kind of a single asset. It becomes a 2 million ton a year single asset. But it's it doesn't fit into anybody's portfolio well enough, or otherwise it would have been done a long time ago.
Yeah. So I guess I have a couple questions here to wrap up. You'd mentioned that we basically haven't seen a bunch of new exploration or new discoveries. Are there certain geographies, maybe here in the U.S., that could potentially have coal deposits, or certain areas that would be profitable down the line? Or is it basically we've found all the good stuff and we have what we have and that's kind of it?
Yeah, I mean, that's kind of where the U.S. is at this point in time. We know where all the coal is. And I mean, there are projects floating around out there now that it's really just dependent on quality. If you have good quality reserves, and you have the capital to go get them, there could be a few projects that come online. You could see a mix in product quality, change in product quality or something like that, but not in the U.S. We're not going to see that. In Australia, they know where the coal is too. So that's kind of a non-starter as well. We kind of know what those projects are, which ones are coming online. Down there, it's more about, Q Coal's by Irwin mine, the Olive Downs expansion, Centurion, Vitronite Resources, Vulcan mine. Those are the ones that I've been looking at that are pretty high quality material. Olive Downs not so much, but it'll be big, at least it has the potential to be big. You might see, depending on what happens with Russia, you could see increased output out of Russia, which might be of decent quality. But it all just kind of depends. I mean, on the thermal coal side, we're again replacing. Western economies consumption is declining, whereas developing economies consumption is increasing. So those kind of balance out. Met coal, we have India growing, China flattening, Europe declining. Those all three kind of balance out. So we just have kind of like steady growth for a while. And we know where enough projects are that nobody's really committed to them, partially because they don't know if they can get money for it.
Yeah.
I think we're in this equilibrium state for a while, and if that is indeed true, then whenever production underperforms, there's upside to prices. That's kind of how I form a market view around that. But no, most of the projects I think at this point are pretty well known.
Yeah,
I do think JSW just maybe acquired some reserves in Mozambique. Mozambique isn't exactly a frontier area, but that could ensure that a project gets developed. But stuff like that, I think you'll need to see before anything comes on, like a steel producer coming in and taking a percentage to drive production or something like that.
Mm-hmm.
That'll be a better indicator.
Yeah, so we got to talk about all these different coal stocks, kind of what's going on in the sector. I'd be curious to hear if you have any other sectors or investments that you find interesting right now, or any other things you're kind of looking at outside of the coal sector.
Obviously copper has been, pretty great. A little bit frothy and it's pulled back, and that's probably deserved here. But as long as Cobre Panama is offline, the market's going to be in deficit. So the question is, in my mind, short term, do they get that back, or can First Quantum develop their Peru mines faster to kind of bring those to market and replace them? That's kind of the question that I have. How quickly is Teck going to bring on QB2? What are the Lundins going to do with the Vicuña district in Argentina and Chile? I own some piece of all those companies at some point in time, because there's, as Robert Friedland so eloquently puts it all the time, there's just, there is no growth like that without copper. Mm. I think the U.S. Steel merger arb trade is pretty interesting. The Nippon Steel takeover that the politicians seem so lined up against doesn't really make any sense to me. Like, Nippon could come in and increase steel production. Like, the union opposition, the political opposition, just seems to me like a bunch of non-experts, kind of just being, anti-foreign ownership more so than having any real substance to it. I think they would probably increase domestic coke production. I think it'd be great for the met coal industry if they were to take it over. And plus Japan's an ally, so there's from a national security perspective, there's no there. So I think that deal ultimately goes through. So instead of being 35 or 36 or whatever it is, Nippon offered to pay 49 for it. I think that's what you get in the end. Whether if politicians scuttle the deal, then at least the Mon Valley Work blast furnace is going to be replaced by Big River Steel and EAF. Going forward, Big River Steel is a project that's coming on, and they're going to get a new core Steel Dynamics type of multiple eventually anyway. So at 35, I'm a buyer of U.S. Steel, I think, for the long term.
Interesting. I'll have to take a closer look. I kind of agree that the political interference seems
dumb. It seems dumb to me.
Yeah.
Capital dumb.
Yeah, it's interesting to watch, but there's a lot of things going on from our political class right now that are that way. So you did mention Teck, and I guess if we can rewind a little bit for a quick question on the coal assets that Glencore, in my opinion, basically stole from Teck.
It's a good way to put it.
And I'd be curious to hear, I saw something recently that they were originally planning to spin the coal assets off, and now they're planning to keep them. But Glencore has been on the watch list for a while, so I'd be curious for your thoughts on that.
I mean, those mines print money. It's like 70% or something like that of Teck's revenue, for God's sake. It's a great acquisition for Glencore. Like, they have, Cerrejón in Colombia, which is super low cost operation on the thermal side, very high quality. Now they've got the Elk Valley Resources mines. They're going to be a monster. The question is just, is the market going to reward Glencore for it? Which, as of yet, they really haven't. I mean, Glencore has great copper assets, and the market just kind of shrugs at it. So I don't necessarily know how to predict its equity performance, but from a straight up company performance, they're going to make a ton of money at those things. And depending on how quickly they can pay off debt, I mean, that's going to go somewhere. And if there's one thing Glencore knows how to do, it's get bigger. That's a company I would figure would use that cash flow to go get more stuff, probably more copper, to be fair. I mean, I agree with him. Like it was too good of a deal to pass up, and I'm glad that it went through. Like if Tech's going to sell to a bigger conglomerate, then I think Glencore is going to be the one to put the money to best use. So I own some. I've never owned a lot, but I've always owned a little. So we'll see how the equity does, like I said. But I just have great confidence that they'll allocate the capital well.
And do you think they decide to go with the spinoff for the coal assets, or you think they're going to keep them in-house?
I just take them at their word. They say right now that they're going to keep them. I assume that means they're going to keep them. If they do spin it out, I definitely want to own whatever the SpinCo is. And if I can't get there without owning Glencore, I guess that means I have to own Glencore anyway, in size. But as to what their motivations are, I don't know. That could honestly go either way in my book. That's not predicting corporate decisions is not always my bailiwick, so to speak.
Yeah, fair enough. I guess the question is, what book should I add to my reading list? And it can be finance, investments, history, anything like that. What do you think would be interesting book to read?
That's a good one. I'll tell you my favorite of the last 5 or 10 years is Narrative Economics by Bob Shiller, the economist at Yale. I like it for a number of reasons, but one of the best books I read prior to that was Thinking Fast and Slow by Daniel Kahneman. Which wasn't necessarily investing involved, but it's sort of a window into how humans communicate and perceive information, right? Mm-hmm. How we process information, how we value it, the cognitive mechanism behind decision making, for instance. In that context, narrative economics goes a little bit more specifically to talk about storytelling. And me as a former recording artist and songwriter, and then afterwards became, I did equity research for companies that had a big direct marketing arm, and I never really understood marketing. I never really understood all those things. And then I read this book, and everything just kind of clicked. Stories that people get attached to, stories that people get, that circulate in the media. They have to have certain characteristics, and he does a really good job of explaining what those are and why people identify with them. And in turn, that's helped me understand the ESG narrative. The ESG narrative exists because it's a constellation of narratives. There are a lot of different individual ones that are kind of around a central theme. When you have, actually, I'll just grab the book and I'll read them to you. Hang on. Easier to do this.
Yeah. No, I think it's interesting because you're right about narratives basically being a driver behind all these different different movements and different themes and trends going on that we see nowadays.
Yeah, well, it's the 7 propositions. The first one is that epidemics, these viral moments for narratives, can be fast or slow or big or small, because people eventually forget them. Like they go out of the news cycle, they go out of your mind. But if they're infectious enough, they'll stay there, and you can pick up on them again. They don't have to be a huge percentage of popular talk. Although with social media, I think it's easier to make something, to broadcast something to a wider audience, right? Mm-hmm. Talked about constellations. If you have a number of stories around a central theme that connect to one another, that's more memorable than otherwise. The economic impact of those narratives can change over time. So like the narrative around Blue Creek, for instance, they're building it now. But once it's built, that narrative is no longer valid. Then it's going to be, what are you going to do with the money? like how corporations tell those stories an ongoing time. For bullshit, right? Truth is not enough to stop false narratives. So if something is wrong and catchy, like, and this is a really good, the coal industry is a really good example of this, because they took to the, what they regarded as federal overreach during the Obama administration very personally, and put out a marketing campaign called, basically called the War on Coal, and it got repeated everywhere. And within that, there were a lot of facts that were put out. Well, you need baseload power generation, you need all these things. That doesn't matter, and especially doesn't matter when you're combative toward the other side. You don't change hearts and minds by telling people that they're wrong. You change hearts and minds by saying, yes, we recognize your viewpoint, and there are other nuances to this viewpoint that you may not have considered. You have to bring somebody along with you. You can't just say, well, here are the facts, and expect the other side to get it. Repetition is Proposition 6 that he has, which is really important. You have people, they have to be simple enough to repeat. That's why we're turned into a soundbite culture. But there's a reason for that. That's how we remember history. And finally, the last one is, and this is probably the most important one, that narratives thrive on attachment, which means human interest, identity, and patriotism. Like, so if you're attached to a certain country, attached to a certain area, attached to when something tugs at your heartstrings, like, it sticks more. And when corporations communicate to investors, like, these things matter, right? You have to be able to really clearly tell your story in order to get it out. That's why people have complained about BTU management. People have complained about Warrior from time to time. Like, it's because they're not being clear about what is it they say. And to be fair, like, these guys are engineers and CEOs. Like, they're not storytellers. They're managers, right? We shouldn't expect them to be able to do that. But as investors, we can let them know, like, it'd be really great if you just, talk to me like I'm a third grader for a portion of these earnings calls, because, retail especially, like, we're listening now, and you catch more flies with honey, and then B, the clearer you explain what your story is to, your audience, the bigger your audience is going to get when it's good. Yeah. So anyway, it was a bit long-winded, but narrative economics by Bob Shiller is probably my favorite one over the past 5-6 years.
No, I appreciate that. I'll definitely have to add it to the list and check it out. The list of books I have to read keeps growing, but I think it's early start to a big library. So
yeah, I mean, I think I read during the pandemic year. I was graciously unemployed and starting up a consulting business, so I had a lot of time. I think I read 30 or 35 books that year. This I read the following year, but it was in a big flurry like that. I learned so much stuff just by doing it. So, make time.
Yeah.
Make time. You take it slow if you have to, but absolutely recommend it for everybody.
That's the plan. Well, I appreciate you coming on. I don't know if you have any last thoughts or anything that we didn't get to cover that would be worth mentioning before we wrap up.
Oh, no, I mean, on my end, you can follow me on Twitter at mfwarder. I'm the publisher of thecoaltrader.com now. It's coal related news and, a premium service with equity analysis, a trading service, and some other stuff. And you can find us on substack.com /thecoaltrader as well. By all means, come check us out and we'd be happy to have you.
Yeah, I can definitely endorse that. I'm a subscriber myself. If you have any significant amount invested in the sector, it's definitely worth every penny. So you guys should definitely go check it out. With that, I think we'll be wrapping up for today. Thanks for stopping by. I'll see you next time.